Welcome. Today, we're diving into the world of the stock market, focusing on 5 powerful verbs that describe how prices move. Understanding these verbs will help you talk about market changes with confidence, whether you're reading financial news or discussing investments. We'll look at each verb's meaning, see simple and advanced examples, and connect them to real market situations. Let's get started on this journey to mastering essential stock market language, beginning with the basics of market movements. Before we jump into the verbs, let's clarify what market movements mean. In the stock market, prices are constantly changing, sometimes rising, sometimes falling, and sometimes staying steady. These changes are called market movements. Investors and analysts watch these movements closely to make decisions about buying or selling stocks. By learning the right verbs, you'll be able to describe these shifts accurately and sound like a pro. Now, let's explore our first essential verb. First verb is fluctuate. To fluctuate means to change continuously, going up and down repeatedly. In the stock market, prices rarely stay the same for long. For example, you might hear stock prices fluctuate every minute. This means they're always moving, sometimes higher, sometimes lower. In more advanced terms, because all prices are unstable, airline stock values fluctuate wildly. This shows how outside factors can cause even bigger changes. Fluctuate is a key word for describing the everyday ups and downs of the market. Let's look at a simple example. Stock prices fluctuate every minute. This sentence shows that prices are always moving, never staying still. It's a common way to talk about the market's natural changes. Whether you're a beginner or an experienced investor, you'll hear and use this verb often. It helps you describe the unpredictable nature of stocks in a clear and concise way. For a more advanced use, consider, because all prices are unstable, airline stock values fluctuate wildly. Here we see how one market factor, oil prices, can cause dramatic changes in another area like airline stocks. This example shows the interconnectedness of markets and how the verb fluctuate captures both small and large shifts. It's perfect for describing complex situations where prices are unpredictable. Next, let's talk about plummet. To plummet means to fall or drop very quickly from a high position. In the stock market, this verb is used when prices suddenly decrease, often because of bad news or unexpected events. For example, the company's stock plummeted after the bad news. This paints a picture of a sharp, fast drop. Plummet is a strong verb that signals a serious decline in value, making it important for discussing market crashes or sudden downturns. Here's a simple example. The company's stock plummeted after the bad news. This sentence tells us that something negative happened, causing the stock price to fall quickly. It's a common way to describe what happens when investors lose confidence or when a company faces trouble. Using plummet helps you communicate the seriousness of a price drop in just one word. For a more advanced example, tech shares plummeted by 15% following the disappointing quarterly earnings report. This sentence gives specific details about how much and why the stocks fell. It shows how news and reports can have a big impact on market prices. Using plummet in this way helps you explain not just the drop, but also the reasons behind it, making your analysis more complete. Now let's move to surge. To surge means to increase suddenly and greatly. In the stock market, this verb is used when prices jump up quickly, often because of positive news or strong demand. For example, share prices surged today. This shows a rapid rise in value. Surge is the opposite of plummet and is used to describe exciting moments when the market is booming. Simple example is, share prices surged today. This tells us that prices went up quickly, possibly because of good news or strong investor interest. It's a positive verb that captures the excitement of a rising market. When you hear surge, think of fast growth and new opportunities for investors. For an advanced example, investors rushed to buy the stock, causing its price to surge to an all-time high. This sentence shows how investor actions can drive prices up quickly. It also highlights the excitement and energy in the market when everyone wants to buy. Using "sir" in this way helps you describe not just the rise, but the reasons and reactions behind it. Let's talk about diversify. To diversify means to put money into many different types of businesses or investments to lower your risk. In the stock market, this is a key strategy for protecting your money. For example, you should diversify your investments. This means not putting all your money in one place. Diversifying helps you avoid big losses if one investment goes down, because others might go up. Simple example, you should diversify your investments. This advice is given to both beginners and experienced investors. It means you shouldn't put all your money into one stock or one type of investment. By spreading your money around, you protect yourself from big losses and increase your chances of steady growth. For a more advanced example, experienced investors diversify their portfolios by purchasing stocks, bonds, and gold. This sentence shows how smart investors use different types of assets to balance risk and reward. Diversifying isn't just about having many investments, it's about choosing different kinds that react differently to market changes. This strategy helps you stay safe even when some markets are down. Final verb is yield. To yield means to produce a profit or a result. In the stock market, yield is often used to talk about how much money an investment makes over time. For example, safe stocks yield low returns. This means that while some investments are safe, they don't make a lot of money. Yield helps you talk about the results of your investment choices. Simple example, safe stocks yield low returns. This sentence explains that some investments are less risky but don't make much money. It's a common way to compare different types of stocks and their potential profits. Yield is a useful verb for talking about what you get back from your investments. For an advanced example, smart investments usually yield substantial profits over a long period. This shows that with careful planning and patience, your investments can produce significant returns. Yield is often used when talking about long-term growth and the benefits of making wise choices in the market. Let's compare fluctuate and plummet. While both describe changes in stock prices, fluctuate means regular ups and downs, while plummet means a sudden, sharp drop. For example, a stock might fluctuate during the day but plummet after a major news event. Understanding the difference helps you describe market movements more accurately. Now let's look at surge and plummet. These verbs are opposites. Surge means a sudden, strong rise, while plummet means a sudden, strong fall. For example, after good news, a stock might surge, but after bad news, it might plummet. Using these verbs helps you paint a clear picture of market reactions. Diversifying your investments is one of the best ways to protect yourself from big losses. By spreading your money across different assets, you reduce the risk that one bad investment will hurt your overall portfolio. This strategy is used by both beginners and experts to keep their money safe in a changing market. Yield is a key factor when choosing investments. Some people prefer safe stocks with low yields, while others take more risks for high yields. Understanding how yield works helps you make better decisions about where to put your money and what kind of returns to expect. Market news plays a big role in how stocks fluctuate, surge, or plummet. Positive news can cause prices to surge, while negative news can make them plummet. Staying informed helps you react quickly and use these verbs to describe what's happening in the market. When you analyze the market, using verbs like fluctuate, plummet, surge, diversify, and yield makes your explanations clearer and more professional. These words help you describe trends, risks, and results in a way that others can easily understand. Practice using them in your own market analysis. You'll often see fluctuate in daily market reports. Reporters use it to describe the normal ups and downs of stock prices throughout the day. It's a neutral verb that doesn't suggest whether the market is doing well or badly, just that it's moving. During a market crisis, you'll hear plummet used often. This verb captures the fear and urgency when prices fall quickly. It's important to recognize when a drop is just a fluctuation or when it's a true plummet, as this can affect your investment decisions. In a bull market, when prices are rising, you'll hear surge a lot. This verb captures the excitement and optimism as investors see their stocks go up quickly. It's a positive word that signals opportunity and growth. Diversifying isn't just about safety, it's also about long-term success. By having a mix of investments, you can benefit from different market trends and reduce the impact of any single loss. This approach is recommended by most financial experts. Yield is also important for those seeking passive income. Investments that yield regular returns like dividends can provide steady cash flow. Understanding yield helps you plan for financial goals, whether you want growth or income. Stock prices fluctuate not just locally, but globally. Events in one country can cause fluctuations in markets around the world. This interconnectedness makes it even more important to understand and use the right verbs when talking about market movements. When stocks plummet, investors often react quickly, selling their shares to avoid further losses. This can make the drop even steeper. Understanding how and why stocks plummet helps you stay calm and make better decisions during market downturns. Surge in stock prices can create new opportunities for investors. Quick rises often attract more buyers, leading to even higher prices. Recognizing a surge early can help you take advantage of market trends and maximize your gains. Market volatility means prices can change quickly and unpredictably. Diversifying your investments helps you manage this risk. Even if some stocks fluctuate or plummet, others might surge or yield steady returns, keeping your portfolio balanced. Yield isn't just about immediate profits, it's also about compound growth. When you reinvest your returns, your investments can grow even faster over time. Understanding yield helps you plan for both short-term gains and long-term wealth. Different sectors of the market fluctuate in unique ways. For example, technology stocks might fluctuate more than utility stocks. Knowing how different sectors behave helps you diversify and choose the right investments for your goals. After a stock plummets, it's possible for it to recover over time. Some investors look for opportunities to buy stocks at a low price after a plummet, hoping for a future surge. Understanding these cycles is key to smart investing. Sometimes a surge in prices can lead to a market bubble, where prices rise too quickly and then plummet. Recognizing when a surge is unsustainable can help you avoid losses and make smarter investment choices. Diversifying isn't limited to local markets. You can also invest in global assets to spread your risk even further. This approach helps you benefit from growth in different regions and reduces the impact of local market fluctuations. Different investments yield different returns depending on their risk level. High-risk investments might yield more, but they can also plummet. Low-risk investments yield less but are more stable. Balancing risk and yield is a key part of building a strong portfolio. Market fluctuations are often driven by investor psychology. Fear and excitement can cause prices to move up and down quickly. Understanding these emotions helps you stay calm and make rational decisions, even when the market fluctuates wildly. Protect against plummeting prices, many investors use stop-loss orders. This tool automatically sells a stock if it drops below a certain price, helping you limit your losses. Knowing how to use stop-loss orders is an important part of risk management. Timing the market to catch a surge is challenging. Even experienced investors find it hard to predict when prices will rise quickly. Instead, focus on long-term strategies and use surges as opportunities rather than relying on perfect timing. Diversifying means choosing different asset classes, such as stocks, bonds, and real estate. Each class reacts differently to market changes. By mixing them, you can smooth out your returns and reduce overall risk. Your investment goals will shape the kind of yield you look for. If you want steady income, you might choose investments with regular yields. If you want growth, you might accept more risk for higher potential yields. Matching your goals to your investments is key. Let's review the 5 essential verbs: fluctuate, plummet, surge, diversify, and yield. Each one helps you describe different market movements and strategies. By mastering these verbs, you'll be able to talk about the stock market with confidence and clarity. Congratulations, you've learned 5 powerful verbs that will help you describe market movements like a professional. Practice using fluctuate, plummet, surge, diversify, and yield in your conversations and analysis. With these words, you'll be able to understand and explain the stock market more effectively. Keep learning, stay curious, and watch your financial vocabulary grow.